Good afternoon, everyone. Welcome to this webinar, Investing 101 Asset Allocation on kind of midday. So appreciate your attendance. I'm sure there's still a few participants that will be streaming in, but let's kick it off. So just by way of introduction, for those who don't know me, I'm Jaco Eagar. I just want to mention that I am sitting on the back of a bit of a flu, so if I do cough or a splatter here or there, my humble apologies. But I have a glass of water, and hopefully we'll roll through it. So Investing 101 is a bit of a series we started last year. I think we've probably covered some of this, over the years, in different formats, but we're trying to get and it's 101. So those of you that's been to university, you know that whichever subject you had, you start at the first year, which is 101, and probably the first semester. So we're trying to cover the basics. And when I was putting together these slides, I realized that the beast that it is, which is asset allocation in this case. And as I said, we've done a few others. We've done options and bonds, and maybe another one already last year. I realized that it is quite a a wide, there's a wide array of concepts underlying asset allocation. And some of it, like strategic versus tactical asset allocation, we can potentially spend the whole webinar just on that. So there are quite a few concepts that we'll cover. Unfortunately, we can't cover them in the depth necessary. So uh, the thinking is to do Investing 101 and to cover a number of topics, and then hopefully Investing 201, we can start choosing and zooming in on some deeper aspects of each of these these sessions that we do. However, we are a phone call or an email or a WhatsApp away. So, if you have questions or you wanted to drill into anything I've said today deeper than what I'm going to do, please feel free to reach out, and we can continue the conversation. But that being said, let's dig into it. So Rand Swiss, if you don't know who we are, very quickly, I think we have, call it, three pillars that you may or may not know. But securities broking, which is the active trading or the private broking account. We lump forex dealing, the Rand dollar, Rand euro, Rand pound exchange rates, or whichever one, Aussie dollar, choose one, where we convert it for clients on very good rates. We lump that together in securities broking. So that's the one pillar. The other pillar is managed solutions. So as you know, we have a number of model portfolios. I'll briefly touch on it right at the end of this presentation as well. So those model portfolios all fall under managed solutions, and then structured products we feel should fall under managed solutions as well, because a structured product, in our view at least, is one of the pillars of a broader wealth plan or product, portfolio of underlying instruments that a client should have. A very powerful tool. And then the third pillar is wealth and advisory. And there we cover obviously investments, estate planning, risk and insurance, and each of those headings obviously have a number of subheadings. So today, asset allocation will focus on the last two, so managed solutions and wealth and advisory. So everything we do there, or a lot of what we do in those two pillars, have a asset allocation base. So I think those two will be, you can keep top of mind. On the right-hand side, some of the, product providers and houses we partner with, and we use their products. to give you, best of breed solutions as a client. From a ranking point of view, this is close to our hearts, and we got top overall securities broker again. So 4 out of the last 5 years, which we're very proud of, and it's always something we aim to achieve. And more than half. Gary has all the details in terms of how much percentage is chosen by who, but I think more than half of it is it accounts for client scores. So it's important that our clients are happy with the service and product set they receive from us. So something we're proud of. There you can see it. So the yellow ones are obviously last year, and these blue ones are some of the other years. But I thought just to highlight this one, SA's top lump sum. So they have these categories that they also score us in, and one of the categories we won last year was the SA's top lump sum investor award, which we obviously proud of. But I thought when we talk about asset allocation, a lump sum and asset allocation is usually synonymous. So hopefully that's something that we can expand on in this session. So let's jump into it. Now, we always have to start somewhere, and I promise this will be the most boring slide. I'm not promising that there's going to be exciting slides, but I promise that this is the most boring one, because I don't even want to call it a definition, but it's just a couple of sentences just to position what we're talking about today. So very basically, asset allocation involves strategically distributing investments across various asset classes. So now, here we talk about asset classes, and they give a few examples: stocks, bonds, real estate, alternatives. You can add income, cash, whatever you wish. But you'll see, I want to take this one level deeper, because I think the asset allocation is also important in subsets or subclasses. So within equity, we have local, international, etc., or we have mining or property or whatever. There are many subsectors to, let's say, stocks, for example, or bonds, local, emerging market bonds, government bonds, corporate bonds, and etc. So we have quite a number of underlying instruments to each of these classes that we also need to consider, and that we also need to, as they term it, they strategically distribute between. But we'll get obviously deeper into that. Then secondly, its primary role, asset allocation, is in portfolio management, is to optimize the risk-adjusted returns by balancing the portfolio for gains within a level of risk tolerated. All right, so again, very boring, a mouthful, but all that we're trying to say here is it's risk-adjusted. So for every unit of risk we take, whichever unit that is, we can quantify that however we wish. But for every unit of risk, we need to get a better than average unit of reward for each of those units of risk. And there's a couple of ways, choosing best of breed fund managers, etc., etc. So every person or house that you're going to talk to will tell you how they think around it, and obviously we'll do the same. But we need to optimize the risk-adjusted returns, and we'll get to that in more depth. Asset allocation decisions are based on factors such as investment goals, time horizon, and risk tolerance, and that's very important to understand your risk tolerance versus time horizon versus investment goals. So we may have an investment goal that is very high. You started saving for retirement too late or something like that. I'm just taking anything general now. So the goal is very high. The time horizon might be too short, and therefore your low risk tolerance may not be appropriate to achieve those results, etc. And I can give you, obviously, a number, probably 100 different scenarios of those three coming together, but we're going to chat about them individually because they are important to get to the correct asset allocation. Then it allows investors to diversify their portfolios, and diversification you would have heard a number of times, and I think we'll expand a bit on that, but that is definitely important. And then spreading risk across different types of assets to minimize the impact of volatility on any single investment. So we're going to dive deeper into that, but again, it's back to the risk-adjusted returns or risk reward to say, if we add an instrument into a portfolio, why do we add it? Does it give us a better growth path, a smoother growth path? What is the reason for adding it? And then that's obviously part of today's asset allocation chat. And then the effective asset allocation requires ongoing monitoring and periodic adjustments to align with changing market conditions and individual financial circumstances. All that sentence means is we need to chat to you not less than once a year. Typically more often, every 6 months, every 3 months, depending on your specific needs. But there is not at Ransus, we don't give you a portfolio of instruments, stocks, whatever they may be, local or offshore, and then we leave you and don't chat to you for the next 5 years. That's not how it works. And we feel that is very important for effective asset allocation to monitor these on an ongoing basis, and then obviously periodically adjust as we see changes happening in the market, etc. And for you as a client or a investor in markets locally and globally, you also have to reassess you have to have this ongoing monitoring process yourself as as owner of these assets, to make sure that we have the conversations every couple of months, every year, at least maximum a year. You can't leave these things for more than a year, where you have to reassess. All right, so very much introduction. Diversification. I think diversification is probably one of the most referred to concepts in asset allocation, and it's that old adage of don't have all your eggs in one basket. So I always joke to say, well, the guy now he doesn't have the eggs in one basket. He now has 5 or 6 or 7 baskets, each with one egg in. 3, 4 baskets in each hand. And now he's well diversified. I don't think that is the end of the conversation, because now he trips with 6, 7, 8 different baskets. So he didn't put all his eggs in one basket, but he falls with all the baskets at once. And that's my analogy can almost count, describe not last year. I feel like it was in 2023, 2 years ago, 2022, which obviously from a volatility point of view, it started off with a bang, and it didn't get better really throughout the year of 2022, where everything seemed correlated, and is why I'm telling this story, because the one guy with the 6, 7, 8 baskets in the 2 hands, tripping over a stone, falling with all baskets, that's basically what 2022 was in investment markets. So we need to add to the diversification, and we're going to get there later, but we need to add to the diversification conversation to say, not only must the eggs all be in different baskets, but potentially in different hands. So when one guy falls, the one egg in the basket breaks, but at least he didn't fall with all the baskets, although he has been so diversified. So that concept is called correlation, or more specifically, non-correlation. I want these different baskets not to be correlated to one another. So I think diversification, very important, paramount, but you cannot have the diversification conversation without the correlation conversation, combined with it. And we're going to get into that. Risk return trade-off is obviously this risk reward. It's a bit of a balancing act. Time frame is important because if you have a 10-year time horizon versus a 1-year time horizon, then the risk return looks completely different. As you know, S&P and markets are at all-time highs. Bitcoin is practically at an all-time high, or was, a couple of weeks or a week ago. So do you now, if you have a 1-year time horizon, go into one of the most volatile things, let's say a Bitcoin or equity market or whatever, and and invest for 1 year? If that's the goal, then if that's the horizon, 1 year is the horizon, then a high risk instrument is probably not the right place to be. However, if you say, let's look over a 5-year period or 10-year period or whatever the investment term is, it's a different story. So this risk return trade-off, has the financial goals, as I said, the timing, etc. We need to understand all of that to get to the correct risk return trade-off. I think I've already now explained the time horizon as well. The longer the time horizon, we can take a higher level of risk, and obviously we'll talk about that a little bit later. But in essence, if you say to me, I'm retiring today, or I want to retire, it doesn't matter, but retiring today is a good analogy I can use. Typically, I'm not saying you're going to get to 200 years of age, but they tell us that the first person who will live to 200 has been born. And so I don't know how they got to that, but that's definitely a theory that's out there. The first person that will live to 200 has been born already. Now, keep that in the back of your mind. If you now it's retire and in South Africa we can retire from age 55 onwards. But let's say you're 55 or 60 or 65 or 70, from a life expectancy perspective, you have another 10, 20, 30 years, then we just had my mother's 80th birthday this past weekend, so if she retired at 55, it's another 25 years that she needed to have a look at it. So we need to, when you retire, understand that you have income needs, which is short term, but then you have the medium and longer term to stay relevant. Because over 25 years, if you just have an income asset, just something like a money market, etc., the time frame is too long for you to stay competitive. You're gonna, inflation is going to eat into the purchasing power of that money. So you'll have to put in a short-term bucket money to live for 2-3 years, and then everything else needs to go into medium and longer term buckets where you can enhance the risk that you take to get a better return, to stay relevant from a inflation and a purchasing power of your money perspective. Rebalancing is important. So from an asset allocation point of view, and then the example I can maybe quickly just mention is NVIDIA. So NVIDIA in our global equity portfolio is one of the holdings we've held for many years. But the last, I think, 2 years, NVIDIA has grown by something like 1,000%. It was absolutely ridiculous in terms of returns. So it's brought a lot of obviously growth to the portfolio if you had NVIDIA. But one of the things that happened is because it outperformed basically all the other 2025 instruments or stocks that we have in our global equity portfolio. It became very quickly over a 10-12% holding. Now that's too much from a concentration risk perspective. So that's where we get to with rebalancing. And I'm now using an equity portfolio, but you can apply that to any underlying instrument or portfolio of instruments. So the rebalancing is important to just shave it off. So we had to, from a concentration risk point of view, cut back on NVIDIA a number of times. So just a quick point that we do need to revisit when we look at these portfolios on a whatever time frame basis, 3 months, 6 months, 1 year, doesn't matter. We need to do consider the rebalance. Okay, last one here is in strategic versus tactical asset allocation, and I think it's an important one just to stand still at for 1 or 2 minutes. So a strategic asset allocation. So let's say we want to achieve a certain goal, and you'll see some of these goals in the next couple of slides. But we want to achieve a certain goal, and that goal is whatever, 5% per annum, 10% per annum, choose a goal. We then look at the time horizon, and then we figure out from a risk reward perspective what is the correct asset allocation. In other words, how stocks or equities, how many percentage points are we going to give it, how big a piece of the pie are we going to give to equity, to bonds, to real estate, to offshore, to local, etc., etc. So once we decide that initially, that's what we call the strategic asset allocation. So we have a goal at the end, we want to earn X percent over the next 5, 10, 15, 20, 1 year, whatever the time frame is. Then we decide on an asset allocation that is appropriate. And let's say that is, just to make my life simple for today, let's say that is 50% equity, 50% bonds, and we're going to see an example just now. But 50% equity, 50% bond, let's say that is my strategic asset allocation for whatever the set of reasons underlying that may be. But that's it. And that's then strategically. But then the difference between strategic and tactically, strategic will run now forever. Not forever until I review it, but it's a kind of a long-term hat when I talk strategic asset allocation. When I then talk about tactical, I kind of take my long-term hat off and put my short-term hat on. Because now I can tactically adjust that 50-50 that I have for certain reasons. Let's take the reason I just used in the global equity portfolio. We might be tech heavy, might have been tech heavy in that 50% equity allocation. Now we need to say to ourselves, well, tech has run so hard. Let's assume we can't change the underlying makeup of what the equity looks like. So tech has run so hard, let's assume it's going to pull back. Don't shoot me, I'm just making assumptions now. I'm just trying to give you a scenario. Let's assume for XYZ reason, we expect a pullback on tech, and because it's so, kind of the magnificent is so highly weighted in S&P 500, for example, or global markets in essence, to be honest. But we feel that now it's probably an appropriate time to cut back on the equity exposure in our 50-50 portfolio. Remember, 50% equity, 50% bonds. So if I think this next 6 months is going to be iffy, let's cut back, then I'm going to tactically, the strategic one stays the same inherently, but tactically for a short-term reason, for a short-term period and a short-term reason, I am now going to change the 50% equity to maybe 40% equity, argument's sake, because I feel we need to underweight equity a little bit, just so we don't, get involved in a volatility that may be, according to my reasoning set, coming in the next 6 months. So then I go 40% equity and then 60%. So that 10% that I'm giving up, I'm taking it up in bonds. So then it's 40% equity, 60% bonds. And that's a tactical decision. So that's the difference between a strategic asset allocation, because in 6 months, 12 months from now, then I'm going to reevaluate and I say, is the reason why it made a tactical change still valid? Yes, no, let's say no. Then I'm back to my 50-50 portfolio and I adjust accordingly. So that's the difference between strategic and tactical. Now, and this is what we call the smarty box. And I'm sure, and there's different versions. Let me show you the next page as well. That's another version of it, but this is the old mutual version. And they've sent out this smarty box forever. So the reason I take this one is a little bit older, it goes up to Feb of 2020. But why I'm putting it up is just to show you what asset classes do. And if you want to follow any asset class, this is from 2006. This is about 14 years that you're looking at. So if you want to go to this kind of reddish pinkish one, SA equity did well there, and then it dropped in 2008, 2009, and then 2 great years following, and then it kind of hovered, and then the last couple of years haven't been great, and in this graph at least. So if you want to follow anyone, real estate is the orange one. You can see how it ebbs and flows over time. Now in the right hand corner, hopefully you can see it at the top here, the 5-year return. Sorry, the 5-year return. And this is now from Feb 2020 backwards. We will see a more updated one now, but just to give you an idea, foreign equity, came out tops over a 5, 10, and a 15-year period. And one of the main reasons, obviously, is the weakening rand. You have that rand dollar depreciation, that interest rate differential or inflation rate differential that will always be prevalent and give you that couple of percentage points growth just by virtue of the weakening rand. And then foreign equity has done well over certain periods, and especially post 2020 as well. But what I'm trying to say to show you here is how important asset allocation is. Because if I put 100% in SA real estate, and in February 2006, I was very happy. And then in February 2018, it was minus 5.2%. The following year, minus 4.8%. The year after that, minus 19%. So the last 5 years, it's been on average minus 4.6%. So if I'm losing 5% every year in SA real estate for the last 5 years, I'm not going to be too happy. So just to emphasize this point that the asset allocation and diversification is very important. We'll drill deeper into that, but I just wanted to add some points here. When we look at this side, it tells a story about diversification. It tells a story about market timing. It tells a story about correlation, how these things work and run together or don't run together. And if you go and look at foreign equity and SA real estate, it's almost like their correlation is very low. Can you see that? When foreign equity is on top, SA real estate is at the bottom. And I'm not saying, I haven't even looked at the correlation between the two to make the point. I'm just trying to show you that there are these forces underlying that may or may not be happening. It tells a story about time horizon, and it tells a story about tactical asset allocation that we've just had, and others. I just put 5 kind of points down here. But we can almost, with this screenshot here, this Smarty Box, we can almost spend, the whole 45 minutes to an hour of, asset allocation presentation, because everything that is relevant is almost on this slide, and has bearing to some extent when we talk about asset allocation and everything underlying it. All the different nuances that we need to take into consideration. All right. That is, as I said, an older one. Let's give you an update at the fresh one. So this one, that was thanks to Old Mutual. This one is thank you to Centio Capital. They send one out to everybody on their list every month. So this was the end of Feb one, which is the latest one I got. And then you can see it's now not from 2006, it's from 2018. But it just gives you a bit of an updated view. I mean, no surprise that global equity over the last 5 years have done really well, but also 10 and 15 years. And as I said, a lot of this is around weakening. And you can go on and look at everything. As I said, local property didn't do too well the last couple of years, and you can go through all of these with a fine-tooth comb if you wish. However, the point I'm trying to get to here is back to asset allocation. So we're going to look at what a balanced portfolio looks like in the next couple of slides. But just to give you an idea of, and you can see a balanced portfolio also jumping around a bit, obviously here. But over a 5-year period, over a 10-year period, over a 15-year period, you can see it is, kind of in the top half. So if you didn't choose correctly, and your risk profile doesn't allow you to, and we're going to see all of this just now, allow you to be in a global equity portfolio, just from a personality point of view, and we'll see why just now. A balanced approach is a good one, and therefore the asset allocation conversation we're having right now is paramount. So let's look at that then. So here you'll see. So the top row is just to put them in kind of wide definitions. The top row is here. You'll see, hopefully you can see my mouse, the arrow of my mouse moving over the screen. So this top row, the top row is the income portfolio. So in an income portfolio is typically 70% in bonds or bond equivalents and more. So above 70%. So what am I saying? Equity is only 30% or less. So and that's the top row. Yeah. So this portfolio is 100% bond portfolio. This is 80% bond. This is 70% bond. So the top row is what we consider an income portfolio. A balanced portfolio is anything between 40 and 60% in equity or stocks. So here I've just took the two extremes, and this is thank you to Vanguard. This slide, by the way, I took these from a Vanguard report. But here you can see 40% in stocks, and there's a little bit of a higher risk on this one, 60% in stocks. But this is typically what is considered a balanced or the typical makeup of a balanced portfolio. And then the third row, the bottom one here, is when we say something is a growth portfolio. So growth is then 70% and above in equity, up to 100% in equity or stocks. So 70, 30, 80, 20, and 100. Now you're gonna receive this slideshow, in a day or two from our marketing department. But what I'm trying to just illustrate here is part of the risk profile or the risk tolerance. When you have and this is the returns is almost 100 years, so it's a good data set to look at. When you look at bonds, the worst year was in 2022, 2 years ago. And it was minus 13%. That was the worst year over the last 100 years. let's move all the way up the risk spectrum to equities or stocks. The worst year, yeah, 1931, it's a while ago, but that was minus 43%. But I will also in 2020, we had a minus 19, minus 20% on the S&P 500. So, I mean, just to give you an idea, the volatility when you're in stocks, which is part of the decision-making process when we talk about asset allocation, is what is your risk profile, or your, how willing are you to ride these bumps out or not? Because if you don't like volatility, you don't like to see I put in 100 Rand and that 100 Rand is now worth 50 Rand. But you just have to sit on your hands for a couple of years to make it look slightly better. Then if you can't do that, then you're more on this side. You're more conservative. You're on bonds. But if you can stomach that from a time horizon perspective, then you're more here on the risky side, where the potential is for a minus 43% in 1 year, half of your money gone. You need to make 100% just to get back to zero. I mean, it's emotionally quite a tough one to be able to handle. But the return that it gives you is almost double. So you can see the average return here gives you 10.1. Sorry about that. It gives you 10.1. And over here, it gives you 5.1. So you basically, you get double the return for that added stress and gray hair that you're going to get. But so you get rewarded for it. However, it depends on your personality as well. But we're going to go deeper into that in a few slides. Let's just go back to diversification. So only stocks, we're not really diversified, right? If we now add, and this slide just have US bonds and large stocks and a bit of cash, you kind of say, well, we are more diversified, and I would agree with there's a more, but you're still not really diversified. When it looks like this, even cash can have different types underlying. But when you have different bonds, emerging market corporate, emerging market government, US government, Europe, EU government bonds, UK government bonds, private debt in developed markets, etc. So once you look at your bond allocation, or whichever one we're talking about, maybe property, maybe alternative assets, etc., which we'll get to in a few slides. But whichever one we talk to, really real good diversification is having a larger, all those eggs in different baskets. And then that non-correlation has to play a part here as well, which we'll get to just now. But so that this is more, what a good diversification will look like in this specific asset allocation. And there you can see the same thing in stock. And it's not only large stock. So I can use the analogy now. The Magnificent Seven, as you know, have run really, really hard in the last kind of year to two. But from a diversification point of view, if you only have those 7 large stocks, you're not well diversified. But you can have them overweight there, and then everything else below that. So those subclasses, there may be lots of value. Small cap US is one that I think needs to be in every portfolio at the moment. So put this on a small cap US, for example, and there's reasoning behind it. And please, this is not advice. So if you need advice, don't. These are just facts that I'm trying to relate to you. So it's one of the views we have. But don't take it as advice. Rather have a chat and make it proper advice should you wish. But I think, just as an example, emerging market, sorry, a US small cap is probably not a bad one to have over here. So that's what real diversification looks like visually. Okay, so diversification is one thing. Just back to the holding period thing. So this is for almost 40 years, and it just shows you that volatility visually now. So, if I look back at between December 1924 to December 2019, so again, almost 100 years. If I look back at any 5-year period, I could have, and this is SA equity, South African equities, I could have lost 14% from a 5-year period, right? So I invest today and I look back 5 years from now. I could have lost 14% and I could have made 31%, any given 5-year period, the best and the worst. The average it gives you here on the brown dotted line. Over a 10-year period, -6, 21 SA equities. And you can see what's happening here. So that's the only point I'm trying to. The longer the time frame, that's how we get rid of this volatility. So if you have a short time frame and you can't handle volatility, whether that's emotionally or just by way of lifestyle, you need this money to survive on, etc. Doesn't matter which one you are, then you cannot be fully invested in an equity portfolio from an asset allocation point of view. But as we go longer from a holding period or a time frame point of view, you can see how that risk comes down and you get closer to the average over time. Okay. The other thing that so this is one of the systems we use. It's called Morningstar, but you may have heard of it. But this is just a portfolio X-ray. So all that I'm trying to get to show you here is there's now different ways to diversify. Now, as you can clearly see, this fund, and I just took the name of the fund. It's a offshore equity fund. I just took it out because it's not relevant. But if you want it, I can tell you what it is. Send me an email or a WhatsApp or whatever. But that's not the important part. What I'm just trying to show you here is from a diversification and correlation and style point of view, it's all important things that I think you need to look at. So from an asset allocation point of view, you can see 96.5, 97% is in equity. So we know this is the equity fund. We know it's offshore because we can see, North America, Europe, the developed Europe, and what's the green one is probably UK. So we can see, it's an offshore equity fund very clearly, but we can already see from a diversification point of view, we have a regional diversification here because we're not 100% in the US. We have a bit of UK and a lot of Europe as well. So that's the one factor. And then from a style point of view, we can also see, here they just look at the underlying holdings. How many are considered large cap equity? 5, 5 plus 28 plus 46 is whatever it is, but a large percentage is large cap. So you can see this is probably well-known brands that's gonna sit in this equity portfolio. This will be mid cap and this will be small cap. So this equity manager has no small cap exposure, however, does have some mid cap exposure. Then from a style point of view, is it value? Is it a blend between value and growth? Probably a little bit, but it's an overweighted growth portfolio. So we're going to look at the, more the growth orientated stocks lying underneath. Now, what I'm trying to get to here is just based on this, I can see this fund manager has a very growth orientated mandate or mindset. If I now wanted to add another, let's say this is the part where I want international equity exposure, because this is an international equity fund. So let's say I want to now get international equity exposure in my portfolio. A good way of diversification would now be to say, okay, well, this is a growth, definitely a growth mindset or mandate fund manager. Maybe let's not go overweight growth. Why not look at the rest of this matrix? You know, we may look at somebody that's more value orientated, give us some diversification, or you know, maybe small cap. As I said, US is not a bad place to be. So now we can get three, and we can put maybe a more value manager and a small cap manager in there, just to give us a better diversification, and that leads to correlation or non-correlation. So when everything falls, if the Magnificent Seven, let's assume they're going to fall, and I'm not saying they're going to fall, I'm just saying let's assume they're going to fall, is going to fall 20%. Hopefully, they're not as correlated to small caps. And small caps, you know, give us a bit of a diversification benefit in our fund. All right. And then here's a correlation matrix in terms of the different stocks. So you can see Microsoft, which is obviously, you know, tech AI type of play. Novo Nordisk is more a pharmaceutical play. So you can see the correlation between, and correlation goes up to 1, by the way. So if you want something, a group of instruments, if I could build the perfect portfolio, I would build a group of instruments, and however many there are, 2, 10, 20, 30. But if they have no correlation to each other, so they can stand on their own merit. Doesn't matter if the world is burning or there's a war in the Ukraine or whatever, you know. You make the list of all the issues we have worldwide these days, political or macroeconomic factors that's on the news every second of every day. If I can have different instruments that are not correlated, non-correlated, that stand in their own kind of silo on their own merit. They grow irrespective of what the other one is doing. You know, that's kind of the perfect world, because then I can no, it doesn't happen often. Obviously, I'm explaining a utopia to you now, but if I could, you know, then I could say I'm investing in this thing because it doesn't matter what happens to the others, it's not going to care, and it's going to grow on its own merit, and the next one the same, and the next one the same. So then I have these non-correlated assets, which is not easy to get achieved, but you can see the correlation between a pharmaceutical and a AI tech, big AI tech play, both, you know, large cap, mega cap stocks, is kind of low. So you're starting to achieve that a little bit. And then here you can even go defensive, you know, more sensitive, more cyclical. So look, I don't want to spend too much time on this slide, but what I'm trying to hopefully drive home here is when we diversify, there are more to it than just picking two different equity fund managers or two different equities. You have to understand a little bit deeper from that point of view, what we're trying to achieve and what we're trying to get from a risk reward point of view. I see there are some questions coming in. I'll get to that in a second. I just want to kind of steamroller through one or two more slides. Now, talking about correlation, and I just said I'm creating this utopia, which you don't often get. This is an international hedge fund that is not available in South Africa anyway. So I had to take out the name, and you know, I didn't want to bore you with a name because there's a very specific way that you would have to invest to get exposure to this. But just from an interest sake point of view, this specific hedge fund has zero correlation to US equity, zero correlation to the hedge fund index, to real estate, a little bit to commodities, a little bit to global bonds and cash. So just to show you, when you think of the non-correlation, or those silos that doesn't care about what the rest of the product set is doing, you know, they are out there. Probably this is probably one of the few ones that's this dramatic. I can start creating that utopia I was talking about earlier, um, slowly with these types of instruments. But the point is, it's a correlation or non-correlation is something I think please start thinking about and looking at in your portfolio construction and your asset allocation. Okay, I had a little bit of fun. I did this 4 years ago, this one. So what you see on screen is old data. If you want newer data, happy to do it with you, no problem. But it just brings home a bit of a point. What I did here is SA General Equity, all the funds in the SA General sector. This was 4 years ago, as I said, so a lot of things have changed potentially. One or two haven't, which I saw now when I was putting the slides together. One or two things didn't change, so some of the really good ones are still some of the really good ones. But this was the historic performance from a 6-month point of view, from a 1-year point of view, from a 3-year point of view, and from a 5-year point of view. SA, South African local general equity only. Okay, funds. Just to give you perspective, there's probably about 250 of them out there. What I did is I said, the last 6 months, which 20 were the best? The last year, which 20 were the best? If I look back 3 years from that day, which 20 were the best? And if I look back 5 years from that day, which 20 were the best? And these were the best. I think it was 20. I have to count now. Whatever. Maybe it's 10 or whatever the number was. So, I said top quarter. Sorry. Which ones, repeated in the top quartile. And then I said, okay, anyone, and now I'm going to highlight them in red, any one of these that's only there in one of my 5 periods, 6 months, 1 year, 4 periods, 6 months, 1 year, 3 year, 5 year. Anyone that's only there once, kick him out. And then I went further. I said, okay, anyone that's only there twice, kick them out. And then I said, well, they all have to be there in all 4, just to have some fun. And this was the list. Again, the list is 4 years old. So these 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. These 10 funds out of 230, 40, 50 funds in South African general equity were there every single time from a 6, 1 year, 3 year, 5 year period. You'll ask me, well, Jaco, what are you talking about? Methodical is not in there in 5 years. So I gave methodical a break in this case, because back then it wasn't a 5 year, it was just shy of 5 years. So it didn't have the data points. So I thought to throw it out, because it needed a couple more months would be unfair. Autos dropped off and came back in. So I thought, it obviously had a bad 6 months. To throw it out at that point would be quite nasty. And then, Signia Active Equity, which is one of the best SA general equity funds, which I thought the word active is quite ironic when you know Signia well. But the active equity fund performed well, but only the last 6 months it didn't. That's a very short time frame. Again, thought it would be unfair to take it up. But again, the data is 4 years old, but I wanted to show you what you need to look at when you construct a portfolio. And this is the equity portion of your portfolio. And look at these 10 names. some of them you may know. I doubt you know many of them. I would be quite surprised if, you know, eh, more than 10% of people on this call have more, know more than two or three of these underlying funds. So, understand the data set you're working with. And this is one specific one, SA General Equity. The other thing you may notice is, do you see any of the names um, of the kind of big asset managers? The one where you walk down, you know, the airport in Joburg or drive down the N1 or in Cape Town, through the aisles there. Do you see those names there? No. Which is interesting. But I'm not saying they're not there now. This was 4 years ago. So understand these dynamics when we talk about asset allocation. The other thing we need to understand is cost, and I'm just gonna, stop here very quickly. These are random, and this is on the Momentum Wealth platform that this quote was done. So just a couple of random stocks. It's also old quote, so don't even worry about what is in there and what it means. Literally, some of these equity I threw in there that were on the list. You'll see the Otis, you'll see the Resco, you'll see the 36-1. So I threw in some of the equity stocks just to give you an idea from a cost perspective. Look at what the managers charge. So you get up to 1.73. But there's an admin charge on the Momentum platform of 39 basis points. So they give you a rebate because it's a Momentum fund. So ignore that kind of anomaly. But you can see it goes up to 1, 2, 3%, all the way down to 34 basis points. In our global or our global multi-asset portfolio of funds, we have one ETF tracker that tracks the US market that costs us 0.03%, from an investment manager fee perspective. So I'm trying to show you that, the average then comes out, I think, quite reasonable here of 0.81, although some of them may be more or less expensive. But the point I wanted to make here is when you look at cost in your asset allocation spectrum, please make sure you look at the right reason for the cost. Because you get this thing called a TIC, a total investment charge, and sometimes they look horrible. There's one specific hedge fund in South Africa that it looks 3, 4, 5% with whichever day you look on. So you think it's a horribly expensive, but they have the track record to prove it. And remember, those costs, the track record is always net of the fees. So these charges that you see and versus the performance that you see, it's net of the charges. So don't just throw out a instrument because it looks expensive. Throw it out because of all the other reasons. There might be a reason why it's expensive and you might want to pay up to have it, as a side note in terms of costs. Sorry, I see my time is running out fast. I just want to explain this one quickly. So there's this thing called the modern, or this theory called modern portfolio theory, and you need a university degree to understand it, but it's to say when you combine a portfolio, you put it on an efficient frontier. And if you give it different weights, so this is 100% core and that's 100% AT1, doesn't matter what they mean. And that's a mix of all of them. You can see if I mix them, I don't have to have only core because if I mix them, there's a point where I outperform core, and this is volatility at the bottom here. Sorry. Volatility at the bottom here. And I almost halve the volatility. Or, shave 30, 40% of the volatility. So I get a better portfolio, better performance, and much less volatile. So my risk reward ratio is absolutely superior by mixing it correctly. And now we can go on the efficient frontier and choose the best. But this is a two-stock portfolio. If we now add something else, and then this is a fixed income thing that I just used to show you. So this pinkish purpley line, red maybe on your screen, you can see it even takes the bottom end. So the top end, not really. So it gives it a little bit less volatility, but you see those 2 points, less volatility, but less performance. But over here, I'm getting the same, the same performance for much less volatility. So then it becomes a conversation to say, well, if I add something into my asset allocation mix, it's probably important to understand what it does to it. And there are some, alternative products like hedge funds that when you add them to your portfolio set, you get a much better efficient frontier. These curves that you look at on screen now. Risk tolerance and your investment objectives. This is a rough framework, you know. Um, conservative if you have a time, or if you're conservative and your time horizon is kind of less than 2 years, don't go above kind of 19-20% equity, and you can read, you'll get this slideshow so you can read through this. And then obviously if you have a 7 to 10 year, then we can go quite aggressive. And if you have more of a growth perspective and risk tolerance, then we can add a lot more of the kind of volatile or riskier assets. Lastly, and then I'm going to answer some questions because I see the time is basically up. So this is my last slide before questions is so building blocks. So obviously you can hear that any asset allocation strategy, whether that is for a retirement annuity, for your tax-free savings account, for your international portfolio, or even your local or global just equity portfolios, whatever it is, needs a certain level of asset allocation. From our point of view, some of the building blocks Rand Swiss brings to the table. We have a couple of model portfolios, which is our global equity and our local equity portfolio. Those, we can send you the fact sheets and chat more around them. And the younger brother or sister is the AI portfolio that we've added to that mix. Structured products, I think, is very important in every portfolio, especially from a risk reward point of view. So everything we spoke about now in terms of asset allocation, once you add that efficient frontier, if you add structured products and hedge funds, you get a better payoff profile. For the same amount or less risk, you get a better return. And then from in the wealth and advisory kind of bucket, we have these global multi-asset portfolio funds, and I've explained some of them to you. Local multi-asset portfolio fund, and then obviously more bespoke. So clients come to us and say, I don't want X, Y, and Z. This is what I'm after. These are my thoughts. This is my time frame. And that's just what I'm trying to achieve, and then we'll adjust accordingly. These global portfolio funds and local portfolio funds, they are also tilted towards your risk profile. So you'll have the same. The global one, for example, has 13 funds underlying. You'll have the same 13 funds, but if you have a higher risk, then the equity components and the alternative assets potentially will be larger in terms of the weighting, and obviously vice versa. Okay, so that is me for investing 101, asset allocation. Thank you for being here. I see there are some questions. I'm going to answer them now. If you have anything else, please, reach out, email, you can phone the office or me on my cell phone directly. I don't mind. So let's just look at these questions. Where would you add bonds and diversified investments? Sure, that was probably now specific to one of the slides, so apologies if I'm not putting it in the correct context, but bonds and diversified investments, I think you should also always look at it from a higher level, right? So I always use this thousand foot view. And I think when you look at from a 1,000 foot view downwards, you should have a well-diversified portfolio, and bonds will be part of that well-diversified portfolio. So when you look at your kind of net worth right at the top, looking down, definitely diversified investments and bonds should be added. You may have commented on one of the slides where I was more equity or specific, or more specifically focused. So the example would have been without bonds or anything else, any multi-asset or diversification. Hopefully that answers that question. Another one is, how do we get exposure to alternative investments? Okay, so interesting question, and there are a number of ways. So it's been in the South African world, financial services industry, it's been tough to get proper listed alternative investments. But let's just understand what an alternative investment is quickly. It's very wide in its definition and application. So a real estate portfolio. So if you have a flat, down the road in one of the estates that you're renting out, that can be considered an alternative investment. It can go as far as weather derivatives in the US. It's so wide in terms of what it means. But can you get exposure? Absolutely. You can go and buy a flat down the road. Look on Property 24, whatever it is. So that's a type of alternative investment. Or I think you're probably asking me, how do we get exposure to listed? So within our portfolio. So there's a couple of ways. Many hedge funds have been now regulated. So, 5-10 years ago, it wasn't regulated and it had kind of a bad rap. Hedge funds, for example, for good reasons, but there were very few, black sheep, and then that gave them a bad name. So they are really good hedge funds. That's on most lists now, and the one or two hedge funds that we use all the time, and I showed you one of them earlier, a snapshot of what we do with it. Great hedge funds, and I would really see it in every portfolio. That is now a retail version of that is now on almost all the lists. So you can get it on Momentum Wealth, Sanlam Glacier, 91 Alan Gray. I'm not sure about Alan Gray. I must double check that one. But anyway, a lot of the lists have it. And then of course in your offshore portfolios, there's a much larger breadth of alternative investments. So those are hedge funds, and then there are others that are definitely coming in line online. We had a session with the private debt providers, not about 2 weeks ago, and there are deep conversations to get private debt more accessible, to retail environment. But if I've spoken too much now for the back end of my flu. If the minimums are high enough, so if you have a reasonable number of rands to allocate, then there are more options to look at alternative investments. But you can chat to me afterwards. Sorry. And then the last thing is you have these actively managed certificates these days, which can give you an a different type of alternative investment allocation to your portfolio, and that's through a normal stockbroking account. So there are definitely ways to get exposure to alternative investments. They are getting more and more, and it depends on what we define as alternative investment and which specific ones we're looking at or hunting for. So that answer how to is dependent on which route we're looking at. But yeah, send me an email, phone me, and we can definitely chat about that. My voice is gone, as you can hear, so I'm gonna call it here. I am over time a little bit, but thank you for being online. Send email, questions, phone. Happy to answer them later, and thanks for being with us. All the best.